All right. Looks like we're balancing out here. So I'm going to go ahead and we'll get started. So I want to thank Maria Pearman for joining us today to round out our last day of Cider Business School, focusing on the accounting persona. So I'm going to go ahead and kick it off to her and let her get started. So, hey, Maria, thanks for joining us today.
Thank you. Thanks for having me. My name's Maria, and I'm a CPA. I specialize in beverage alcohol finance. I've been working in this space for 12, 13 years, something like that. And I'm headquartered in Portland, Oregon, but work with clients all over the country. And I'm really excited to be part of this business school for Cider, talking about KPIs. KPIs means key performance indicators. And my personal passion for what I do is the educational piece around helping business owners or key folks in businesses understand their finances so that they can take away barriers to their day job and have a greater chance of success at making their business and oftentimes their dream healthier, more sustainable, successful. So I think that KPIs is a fantastic place to start that conversation. And the title of this presentation is called Demystifying Financials. And the reason why I chose that title is because KPIs allow you to quickly know the pulse of the business, and it doesn't require a thorough understanding of financials or accounting. You don't need to understand debits and credits. This is where the financials are a full report of your business health, but the KPIs is like an executive summary. It's often information from various financial reports that are pulled together or even non-financial data, and it's presented as one number. So it's like a shortcut to answering business questions. So I want to talk about some different areas to measure liquidity, sales, and profitability. And liquidity has to do with your ability to pay obligations as they come due. And it relates to cash and current assets versus current liabilities. And this is business health. So are you going to be able to pay your bills as they come due? And how likely are you to stay in business? So that's what liquidity measures. Another area to measure is sales. This is going to focus on growth rate, on the top line of the business, on the idea of are you making money for profitability. Also, gross margin is the concept of revenue minus your cost of goods sold. So when you sell cider, there's a cost associated with that. And what's left over out of the sales price is what's available to cover operating expenses that you have for your business. And then net income, which is revenue minus all expenses. So it's not necessarily a requirement that you pour over your full financials on a weekly basis, although you should be looking at your full financials at least on a monthly rhythmic basis. But if you can hone in on a few of these key areas on a weekly basis via KPIs, it'll help you keep your finger on the pulse of different aspects of your company and just how you're doing. Because if you wait until your books are closed at the end of the month, it's very useful information, but it's also looking in the rearview mirror, and using KPIs on a weekly basis will help you stay in tune with the hum of the organization on a moment by moment, contemporaneous basis. So the key is to keep your information timely and accurate so that when you pull these KPIs, the data is meaningful. So again, the liquidity, how's your safety net, how much cash do you have on hand? Sales is about your growth, and then profitability has to do with whether or not you're making money. So we're going to talk about each of these in depth and looking at some different ratios for each area. And then we'll also look at some examples of what a KPI dashboard could be set up as in terms of the visuals of it. So we'll get into that later in the program too. This first slide is a series of liquidity ratios. These are all different ratios that speak to the concept of liquidity for your business. So the four that we're going to cover is quick ratio, working capital, debt to equity, and days cash available. So I've given you the name of the ratio, the formulas in the second column, an explanation of what it means, and then targets. So the quick ratio is taking your current assets, excluding inventory from that, and dividing it by current liabilities. This has to do with how well a company can pay its obligations when they come due. And the concept of taking inventory out of this is that you can't pay your bills with the finished goods that you have on hand or the raw materials that you have on hand. So what we're really honing in on is cash and near cash assets. So it's going to be your cash, any other certificates of deposit or very near term cash assets, as well as accounts receivable and any other current assets that you have on hand. So in your quick ratio, ideally you want that to be 1 to 1.5, which means for every dollar of liabilities, you have about $1 or $1.50 of current assets available to cover them. And these targets that I'm giving you in the presentation, they are, I want you to respect them, but it's not the end all be all, because everybody's business is in a different place. And all of these are going to shift and flex depending on a company's individual structure and also where you are in your corporate life cycle. So those are two key parts of a business that's going to shift where your specific target should be. But the quick ratio, generally speaking, you're shooting for 1 to 1.5. Working capital is also sometimes called the current ratio, and this is total current assets divided by current liabilities. So it's very similar to quick ratio, except that you are including the inventory as part of current assets. And just as a short aside, the difference between a current asset and a non-current asset, or a current liability and a non-current liability, is the timing of when that instrument is going to turn into cash in the case of assets, or when you're going to have to pay something in the case of liabilities. So inventory is considered a current asset because the expectation is that within a year's time, whatever you're holding in inventory will have turned into a good that you have sold. And in current liabilities, that's going to be things like accounts payable, credit card debt, payroll liabilities. You're going to have to pay those within the coming year. Whereas if you have long-term debt with a bank, that's a non-current liability because you're not having to pay that until sometime in the future that exceeds 1 year. So the current assets over current liabilities, your working capital, this measures efficiency and short-term financial health. And so because you're including inventory in that numerator, the target is a little more generous than the quick ratio target. So in the working capital, you're looking for 1.5 to 2. That means $1.50 to $2 of current assets divided by current liabilities. So think of working capital as the oil in the engine. And a high working capital ratio isn't always a good thing. That could indicate that you have too much inventory or you're not investing excess cash. So, in a very extreme example, let's assume that you need, quote unquote, need 100 grand in the bank. That's kind of your comfortable level of oil in the engine, if you will, 100 grand. That's kind of what you need to run the business. But for some reason, you've got $1 million in the bank. Well, it makes your working capital ratio very high, but on another sense, it's not really a wise use of your funds because you have, think of cash as a resource and you've got all this excess cash that you're not really doing anything with. Whereas you could take that and invest it in other ways and make money on it versus having it sit as an asset, cash that's not making any money, so you've got a resource that is kind of sitting dormant, if you will, where alternatively you could be putting it to a better use and generating more income and more return for shareholders or stakeholders in the business. Debt to equity is the next KPI that we'll talk about. It's total liabilities divided by total equity. And this measures financial leverage, indicates how much debt a company is using to finance assets relative to equity. So let me pause and just explain the terms leverage and equity. So equity is the cash or resources that the ownership group contributes to a company to get it going. In the case of a cidery, if you have $1 million build out, you might finance that half with money from owners and half through bank debt. And the half that is money from the owners is considered the equity. And anytime that you are using debt to finance the growth of your company or the operations of your company, that is the idea of leverage. So leverage simply means that it is how much in debt a company is. So to finance your operations, you can either choose debt or equity. Debt means the company has borrowed money, and equity means the company has financed the operations or growth itself from the owners. Aggressive leverage practices are often associated with higher risk for companies because you are going to have extra expense in terms of interest. And it also means that you don't truly own the company. You are beholden to your debtors. So you want to keep the debt to equity ratio low. So lower is better than high. And the target I've provided is 1 to 1.25. And that's generally the range that I see for healthy companies in this space. So again, if you think about where your company is in its particular life cycle, as a young company or as a growing company, you might have a lot more debt on the books than an established, mature company, because the larger one, the older one, has had more time under its belt to make money and start to fund expansion and operations out of the net income that the company generates. But regardless, debt to equity measures leverage, and you want to keep that ratio lower rather than higher. Another liquidity ratio is days cash available. And you calculate this, you're going to divide your cash on hand divided by your annual operating budget on a daily basis. So this measures how long the organization can pay operating expenses without receiving additional cash. This is also sometimes called margin of safety. And my recommendation is 90 days cash on hand. I understand that that can be a stretch for a lot of businesses, but it's a goal to work towards. And I really believe that 3 months of cash on hand is a good place to be for most businesses. So we're going to move into sales ratios. The three that we'll go over are inventory turnover, asset turnover, and gross margin percentage. So inventory turnover is calculated by taking your cost of goods sold divided by average inventory. And the concept of this is that it measures how fast a company sells inventory and is generally compared against industry averages. So in other words, how many times are you turning over the inventory on your floor? If you've got $200,000 of finished goods inventory, then how many times could you replace that within a given period? So, let's say we're talking about a year, your ideal target is going to be about 4 to 6 times for that inventory turnover. You want to be moving the inventory through the cycle. If you have a low inventory turnover, that's not good. If you have a high inventory turnover, that is good. So the concept is like, you don't want to have inventory just hanging out on your warehouse floor. You want to make good use of it and be efficient in your processes so that you're taking in raw materials, creating WIP, turning it into finished goods, getting it out the door quickly. And you may have heard the concept of just-in-time inventory. This is really tightly connected to that just-in-time inventory. So just-in-time inventory would have a high inventory turnover because as soon as something is hitting the warehouse floor, it's moving on to the next process. And the production department is working like a well-oiled machine to get that, out the door as quickly as possible. So again, it's a measure of production efficiency and tells you how well you're moving your inventory through the door. Asset turnover is revenue divided by total assets. So this is an example of a KPI where you're going to take information from different financial statements and bring it together into one number. And actually the same is true for the inventory turnover above as well. In the case of asset turnover, revenue is coming from your income statement, which is another name for the P&L. Your assets are coming from your balance sheet. So you're taking pieces from two different financial statements, bringing it together in one number. So in that sense, it's a bit of a shortcut. And this will tell you an indication of the efficiency with which the company is deploying its assets in terms of generating revenue. So, if you buy a piece of equipment, the idea is that you want to maximize the amount of sales that you can get out of that piece of equipment. So higher the turnover ratio, the better. And generally speaking, I'm seeing this in like a 1 to 1.5 range. So it again has to do with efficiency of the company. And then the last ratio in this section is a gross margin percentage. So gross margin is revenue minus cost of goods sold. And this is probably something that most of you are familiar with. And then to get the gross margin percentage, you just take that net number and divide it again by revenue. So it measures the percentage of sales price that's available to cover operating expenses. And this is key because in your day-to-day operations, you have these recurring expenses that are not necessarily related to creating and pushing a good out the door and turning it into a sale, but it's just making the engine run. So how much is left over after you build the widget to cover the operating expenses of the machine, if you will? So target for this industry is going to be somewhere between 50 to 54%. And we're going to look at a pricing model here in a second to talk about what goes into COGS. But quickly, it's, of course, your direct materials, which means all your raw ingredients or any additives therein. It includes production labor, excise taxes, and overhead. The discussion of COGS and the proper costing of goods is a pretty meaty subject, and it's outside of the scope of this conversation. But I do want you to recognize when you're looking at your gross margin ratios, sometimes, and especially for smaller businesses that are just getting started, if you're only looking at the margin and counting in direct materials into your COGS, you're sort of kidding yourself about what your margin is. Your margin does truly need to take into account the excise tax, the labor, the overhead as well, to give you a very clear picture of how much it takes, if you will, to make your good. So here's that slide on product costing. For example, we've got one 4x6 by 16 ounce case of cider. We're going to sell it for $48.50, and you can see your labor and materials, and actually this should say and overhead, but labor materials overhead is about $20.20, and excise tax on that one case is going to be about 50 cents. So our total cost is 43%. And our gross margin is what's left over after those costs of roughly $28. So just an example of how to think about costing and what goes into your product costing. The next set of ratios is profitability ratios, and this has to do with how much money you're making. So EBITDA is a term that you probably have heard, and it's a common measure of the earning potential of the business. This is often used by investors, sometimes lenders, to compare companies. And it's an apples to apples comparison that levels the playing field for different companies to take out the differences in their financial performance that might result from how they're structured. And I'll give you an example in a second. But first, I want to tell you how it's calculated. So the formula for this, you start with net income, which is your bottom line. And then to that, you're going to add interest, taxes, depreciation, and amortization. So you can, if you ever get kind of forgetful about how you come up with this. It really is right in the name of the ratio. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And in terms of the target for this, you're looking at 10 to 14% is a very healthy target. So, especially in 2020, depending on what your business model is like, a lot of producers may not be seeing these numbers, but it's difficult to make any judgments on 2020 because it's been such an anomaly of a year. But if you look back into more of a normal cadence of your business, 10 to 14 is very healthy for EBITDA. And I want to talk a bit about those differences in how a company is set up and why that might cause differences in net income. So I'll give you two examples. One has to do with interest and another has to do with taxes. So let's say, back to this idea of a cidery that it needs $1 million to build out its facility. And I brought up this example early in the presentation where, this company might do it half and half with investor debt and half or investor contributions and half through bank debt. So that company is going to have $500,000 of debt on which it is paying interest over time. So consider that company A. And then company B has the same situation, $1 million build out. They are going to fund that with lion's share of that coming from the investors. So let's say that's 900 grand out of pocket for the investors and only 100 grand from bank debt. So both companies have interest expense, but there's going to be much more interest on the part of company A because a larger portion of the capital investment is in the form of debt. They're highly leveraged versus company B. So when you look at their net income, let's assume they've got exactly the same results with the exception of this interest piece, which is higher for company A. So interest is an expense, which means that the net income of company A is going to be less than that of company B. If an investor or any interested party looked at the bottom line, they would think that company A is a dog and company B is really performing well. But that's not really an apples to apples comparison because you're looking at the bottom line, not the income from operations. And so EBITDA, because you're going to add back interest for both companies, then the EBITDA for both would be equal. And that's a more relevant measurement for stakeholders, for investors, for lenders, etc. So the second example, same thing. Let's say there's company A, company B. Let's assume they've got the same situation going with debt to equity. So interest is like same on both companies. But company A is organized as a C corporation and company B is organized as a partnership. So C corporations pay taxes. They are an entity type where the entity, the business itself, is taxed in terms of federal income tax. So the company is paying tax. And partnerships are flow-through entities, which means that the company itself doesn't pay federal income tax. All the results of the income flows down to the individuals who own the company. So if you look at the income statement, company A, who pays taxes, is going to have a line on their income statement of income tax expense. And company B is not, because that all passes through and goes down to the individual owners. So again, this is an instance where even if the operations are completely the same, completely equal, if you were to look at the net income number, A is going to show a worse net income, worse performance than B. And so with EBITDA, you're going to add those taxes back and create a level playing field so that companies aren't disadvantaged based on how they're organized as a corporation or as an entity. So that's why EBITDA is really helpful. And especially for those of you on the call who might be thinking of some M&A activity, some mergers and acquisitions activity, oftentimes the value that's used when an investor is going to buy a company or any kind of transaction of that nature, it's all EBITDA driven. Not always, but quite often is EBITDA driven. So you might get an offer that is, X times the EBITDA of the company for the last 2 to 3 years on average, something like that. So EBITDA, as you move through the world, it's going to be more helpful for you to understand the ratio and how it's used. Return on assets, net income divided by total assets. We talked about this earlier as in terms of looking at a similar ratio kind of through a different lens. In terms of profitability, it indicates the efficiency with which the company is deploying its assets and generating revenue. So on a different slide, we looked at this as revenue divided by total assets. You can also view this as net income divided by total assets. And return on capital employed, this is taking your earnings before interest and tax and then dividing it by total assets minus your current liabilities. So it measures how well a company generates profits from capital contributed by the owners. And if you are an investor, think of it this way. I could take $1 of my wealth and I could put it into a cidery, and I expect a return of X, versus I could take that same dollar, put it into the market, and on average, the expected return is going to be about 8% in the market. So over the long term. So, if you're looking at the return on capital employed in your cidery investment, oftentimes you can correlate that back to what would I make if I spent this money in other ways? What would I make if I put my dollar in the market instead of in this small business? So that's often how this KPI is used. And it can be helpful for investors to look at this KPI, but also for business owners to look at it as well, because as a business owner, you need to have a handle on the health of your business, how it's perceived by lenders, by investors, other key stakeholders. And this is a great KPI to demonstrate that. And again, this is another example of where we're taking pieces of financial information from different reports and putting it together just in one number. So EBIT is going to be a calculation coming from the income statement, and then the denominator, assets minus current liabilities, that's going to come from the balance sheet. So if you didn't have this KPI, which is a shortcut, then you're going to be, judging this after you pour over the income statement in depth, and then you consider it versus the balance sheet. So KPIs, again, can serve as a shortcut to some of that information. Okay, go over to my notes. So as we move out of some formulas, I just want to talk about production measurements. And these are other KPIs. These are not financial ratios per se, but they are still key performance indicators that are going to be very relevant to your business. So I highly encourage you to measure these type of numbers on a very frequent basis, monthly or even weekly. So packaging labor efficiencies and production labor efficiencies, these are both very tightly connected ideas, but one is just, how good are we as a company at getting through the packaging process? And then the second one, production labor efficiencies, is how efficient and effective are we as a company of using our production labor? Are we getting a high level of return on the amount of money that we spend on production labor? So the calculation for both of these is very similar. The first will be the cost of packaged goods sold divided by packaging labor expense. And the other is total cost of goods sold divided by production labor expense. And the reason why I give you both is because I have seen firsthand with a lot of companies in this space, when it comes to packaging, like packaged goods, that's a place where you can oftentimes see a lot of inefficiencies. And sometimes it's related to the machinery that you're using. Maybe your filler isn't an effective or efficient piece of equipment, but oftentimes it has to do with the labor practices involved as well. And so I have found personally in my experience that looking at labor efficiencies specifically for packaging can be really helpful because it is a common area where there's a hole in the boat. And it's a little more granular than general production labor efficiencies. Revenue per labor dollar. This is a common measurement. So you're going to just take your total revenue divided by your labor expense. And this is a great one to track over time. It can speak to, your sales efficiencies, your production efficiencies. And if you watch this week over week for multiple weeks at a time, you're going to start to see trends, and you start to see the effects of little tweaks that you make along the way pay off in more revenue. So I find it to be an exciting KPI to focus on, especially over time. And percentage of capacity. So this is the current production in barrels divided by the production capacity in barrels. You can measure this in weeks. You can measure it for a year. So let's say that you're going to measure this for a week. For a year. You're going to take your production in barrels for a full year, and then you're going to divide that by the production capacity in barrels. So getting to production capacity can be a little bit of an exercise, but most folks, most operators have a pretty good idea of how much cider they could push out of their facility if they were operating at full tilt. So the production capacity, you're not trying to aim for perfection, but rather an average level of operating efficiency if all of your tanks and your brews are done on a very efficient manner, and you're kind of maximizing the number of brews that you can do all the time with your given set of equipment. So that's something that you would need to calculate out before this would be a helpful KPI. But again, if you are watching this and you see that we're actually only using 80% of our capacity, then that becomes a red flag, because now you're seeing, I'm paying overhead on 100% of my facility. I'm paying 100% of keeping the lights on in this place, but I'm only really utilizing 80% of it. That's going to light a fire to drive more sales and more activity. So really helpful KPI to keep an eye on. Okay, sales measurements. These are, again, not necessarily calculations per se, but they're just numbers that I highly encourage you to keep your eye on week to week. So shipments and depletions, and then the difference between them. Most of you probably already know this, but shipments is that is calculated by the inventory that you are invoicing to your distributors if you have a distribution agreement. So when you create AR by selling your goods to the distributor, that's a shipment, and it's important, and that becomes the revenue for your company. But what is equally important is depletions, and that is the movement of your inventory out of the distributor's warehouse onto points of distributions and into the hands of consumers. So I've seen it before with clients where, let's say that you want to make your number for the end of the year and you're stuffing the channel, which means that you're selling a bunch of goods into the distributor. And then you're doing that to hit your numbers for year end. You do that in December, and then the goods aren't moving in January, maybe into February. That means that although you have done good work by pushing your revenue up in December, now you've got a problem in January, February, because the distributors got that inventory. It's not moving out to points of distribution. It's not being depleted. So that's why shipments and depletions are equally important. You need to have both, and it's really a timing thing. So when you look at the relationship between those two measures, make sure that you're not stuffing channels and getting yourself into a bad spot into a future period. Points of distribution, that means how many locations your product is available in the market. It includes on-premise and off-premise locations. So this is going to be like every grocery store or C-store is a point of distribution, as well as every restaurant or bar, a point of distribution. Now, if you have 2 facings versus 3 facings at a grocery store, that's still just 1 point of distribution. Velocity is another metric which has to do with depletions, and it is how fast your product is turning over at a point of distribution. In the grocery store, are you selling 5 cases a week? Are you selling 10 cases a week? So that's a difference in velocity. The velocity of 10 cases a week would be 2x the velocity of 5 cases a week. So watching the velocity at points of distributions is really important. And I highly recommend, I mean, there's some great softwares out there to measure stuff like this, like VIP is one that you probably have heard of. And if you're not getting visibility into this kind of sales data, you're really hamstringing the information. You're hamstringing yourself because the information that you're working with is a bit limited. So all of those sales measurements, I would highly encourage you to keep on your KPI dashboard as well. So now I want to show you some examples of KPI dashboards. These are going to range from sophisticated to simple. And I hope that this is going to be a big enough picture for you. I know it's a little bit small, but in this setup, you have a circle where every individual square on there represents a different KPI. And the KPIs are grouped by the aspect of business health that it measures. So going around the circle from the bottom left and over, it's measuring profitability, activity, efficiency, asset usage, liquidity, cash flow, and growth. And in this model, the individual name of the KPI is kind of the outward spokes on each one. And, obviously if it's a red X, that means that you missed it for the month. And if it's a green circle, that means well done, you got it. And so this is a fairly sophisticated way to look at your KPIs, but also really helpful because you instantly get the visuals of this. You instantly get, okay, my efficiency looks good, my liquidity looks good, but I've got some work to do in terms of profitability and growth. So that's one way that you can organize the data and look at it. And, you can just in an instant have a sense of how the company is done. This is basically the same information as presented in the prior slide, but obviously different, less visual, more linear in terms of it's structured much more like a traditional financial report. So in this, you've got those same KPIs and it's grouped by the same groupings, but you're going to see financial numbers associated with it. So you've got the actual number that you're looking at versus your targets, and then you can see a trend. So if we were looking at the month of November, this is going to be the November actual, the November target, and then the prior month actual. So you can see, did I move in a positive or negative direction month over month? And then you can also assign importance to some of these KPIs as well. So like some numbers are going to be critical that you definitely feel like, we've got to be on the mark on this every time. And then others are like, this is really helpful information, but it's not that big of a deal if we don't hit our number. So adding that level, that importance barometer is helpful for you to hone in on where to spend your time. This is a much different setup. You can build this in Excel. It's very simple. So one of the points I want to drive home is that you don't have to invest in a big fancy system to do KPIs. You can really put it together very simply in Excel. This is an example of that. Green, yellow, red, very easy. And then this is on the other end of the spectrum, super sophisticated. You've got like an entire cockpit of information there. It's like command central. And personally, to me, this is too much. I don't even know where to begin with this. But some people like looking at it this way. So I just wanted to provide you some ideas. So again, I'm going to kind of go back. So this is like far end of the spectrum. This is simple end of the spectrum. And then this might be somewhere in the middle. These two kind of go hand in hand. But hopefully this gives you an idea of how you could start to put something together. I think, a lot of people get intimidated by building a KPI dashboard, and it seems like such an arduous task, but it doesn't have to be. And just start with something super simple in Excel. And the key is to track it with consistency month over month or week over week, even if it's only 2 or 3 things. And you'll start to see the benefits of going through that on a regular basis. So you've considered which KPIs you want to track. You've built a dashboard. Now, what do you do with that? Well, your dashboard isn't going to be helpful if you don't have data that's timely and accurate. I mean, that is kind of number one. You got to have timely and accurate data. And I highly encourage you, if you don't already have somebody who can get those numbers tight and deliver to you timely, do that, because it matters. It really does matter that you've got correct, timely information to work with. The further it takes to get that data, the more you're in a reactionary position, and you want to position yourself to be working through this in a more proactive manner. And then the next thing is to share it with your team. I highly encourage you to share this with your leadership team. In an ideal world, you would have a couple KPIs for every department, a couple for sales, couple for production, couple for finance, and you are making sure the department heads are held accountable for the results in their department. And KPIs are a fantastic way to do that, again, because you don't have to know the ins and outs of debits and credits to be able to communicate these important ideas to those leaders. So you can, it can be as simple as like, our target range for this KPI is 1 to 1.5. This month we were at 0.8. And it's very simple for someone who's coming from a different background to recognize I need to move it in a different direction. And then, talking about the factors that will help move that KPI to where you want it to be. So it's a very effective way to hold people accountable on your team. How will it help you as a business owner? So identifying key performance indicators requires you to question what success means to you. And the KPIs, like we've kind of gone over a lot of them in this presentation, but you don't have to measure all of them. I want every business to focus on the things that are going to move the needle most for them. And every business is going to have its unique KPIs that matter most to them. So I think, especially if you go into this with the idea of, okay, I'm going to limit myself to 5 things I'm going to keep a finger on the pulse on, it really forces you to think about what is most important. Where are my leverage points as a business? What are the really high priority things that if I can change this just 1% or just a point, it's going to move the needle dramatically for me. So it's a good exercise in discipline and thoughtfulness and kind of honing in on what matters. Understanding the drivers of each key performance allows you to focus on the input that needs to be adjusted to affect the desired outcome. So as you think about what are the KPIs that are most helpful to me, it really helps you hone in on what are the things, where are the leverage points in my business that I need to focus on to make the biggest change. Consistent review of key indicators allows you a quick assessment of what's working, what's not, where to focus your energy. So it's, just allows you to stay with it, finger on the pulse of what's going on without having to go through this belabored hour-long review of financials, which again, it's important, but not maybe every week. So that is a lot of information. That's what I got. This is my contact information. If you have any questions about the material that we talked about today or your business specifically, please reach out. And I think we've got a couple questions. Do we want to open it up for people to ask themselves, or do you want to read them off to me?
Yes, so what we'll do is in the Q&A chat box, if you have any questions for Maria, please put them in there, and we will take the rest of this webinar time just kind of answering them. I do know we had someone in the chat ask if the slides will be available after the presentation. Is it best if they just shoot you an email if they would like the slides?
Yep, that'd be fine.
Okay, great. Also, for everybody that's on the webinar, tomorrow, every registrant for any day of Cider Business School, you guys are going to receive an email with a link to an on-demand recording of each webinar from this week. So that will be coming to an inbox near you tomorrow. So you guys can look forward for that. So if you happen to miss any of the sessions or interested in catching them, that will be sent out tomorrow. All right. Doesn't look like we have any questions coming in right now. You can also put questions in the chat as well if anyone is interested. Maria, is that your pup in that picture?
Yeah, that's Roscoe. Yep. Poor baby has to have surgery next week.
Oh,
Yep.
poor thing. All right, it looks like we have a question come through from Darren. What software solutions do you recommend to create a KPI dashboard? That middle ground between Excel and the sophisticated one.
That slide is from a program called Fathom, which I love. It's Fathom is affordable, intuitive, super slick, but not over the top. It's simple, and it integrates directly with QuickBooks and other programs too, like Zero and others also. But I know a lot of folks in the space are on QuickBooks, and so it's super slick because it just integrates automatically, and you can pull reports from there so that the data is instantaneously updated. So Fathom is a great option, and frankly, I would have to say probably my only recommendation. So if it's now they've just partnered with Intuit. So now if you're on QuickBooks Online Advanced, it's like part of the package. Otherwise, you can subscribe, yourself and just do a bolt on to your QuickBooks. But yeah, it's a great program. Easy to use too.
Great. Doesn't look. I'll wait a little bit longer for some questions to come in. But yeah. All right. Well, I guess since we don't have too many questions, we will go ahead and just give everyone maybe like 10 minutes back in their day. Oh, wait, I had one more pocket bin. Do you have any recommendations on financial forecasting software?
Yeah. So actually, the same program Fathom, they have a forecasting module, which is pretty slick. And there's another one called Plan Guru. So it's PLANGURU, Plan Guru. And Plan Guru is great. It's a little more sophisticated, so you need to have a degree of knowledge about, finance and accounting to make the most of it, but it's also a great program.
All right, great. Okay, well, I am going to go ahead. We will give everyone 10 minutes back in their day. If you have any further questions for Maria, she did include her email address there on that last slide, so I encourage you to reach out. Or if you have any questions for us here at Ecos, marketing at goecos.com or visiting our website, goecos.com are the best ways to reach us. So thank you everybody for joining us today. And thank you, Maria, for, partnering with us on this webinar. We really appreciate it.
Thank you.
Thanks.